SoFi was down 10% this week, starting off 2025 in a similar fashion that it started off the last year, and for the exact same reason an analyst downgrade with the same exact firm and many of the same recycled arguments, in fact. In this video, I'm going to be looking at this analyst note, breaking down some of the points, and also what are we doing going forward. I also made some SoFi trades, so stay tuned for that. Let's jump right in. Okay, so I wanted to make this video earlier on this KBW downgrade news, but I've been taking some time off for the last couple of weeks, and I actually won't be back home for another couple of weeks. So the pace has fallen in terms of the content that I'm putting out. But of course, I did see the SoFi stock price, especially since I've begun playing SoFi more recently in the form of cash secured puts. And actually, the timing worked out for me because I had SoFi January 3rd cash secured puts that I closed out on December 30th for about 90% profit. And then the market was closed. And literally, while the market was closed on January 1st, KBW came out with their downgrade. And when SoFi opened trading on January 2nd, it dropped 10% intraday before recovering back some of those losses the following day. And since I'm a little late to the game on this news, particularly, there's a couple of other creators who have done further deeper dives on this. The most in-depth one I saw was from Chris, Data Driven Investing, who literally posted an article on his Substack like 24 hours after the news dropped. I'll link that in the description for those who want to read it further. It's much more in-depth. And as I was thinking about this video, I thought about the level of depth that I want to go into with regards to this analyst note. And the fact of the matter is that I've gone into KBW analyst notes in depth since they had like 3 or 4 last year. I mean, they downgraded in January, they upgraded again in April, and then they like downgraded again in the summer. It's just back and forth. So you're rehashing a lot of old arguments, especially because they're regurgitating a lot of the same arguments that they have in their previous rationale for moving up and down the stock price. And this time is no different because, in essence, KBW's price targets are as a result of their valuation concerns. I looked at this Reuters article who broke it out, I think, in a nice way. The article says, quote, analysts at the brokerage firm KBW have rated the stock underperform with an $8 price target, which if you look over the past 5 days, I mean, SoFi was in the $16 range like last week. They basically say that the strong economy, lower interest rates, and the company's success driving better scale and profitability has justified the investment thesis towards a more long-term view of what a mature SoFi looks like. And I found that really interesting because for me, I see this company as hyper growth mode, as a company still in their infancy, still establishing the things that are going to become stalwarts of their future growth. And meanwhile, KBW is saying, hey, look, this is towards maturity. And so we disagree in terms of where we are in the SoFi story. Quote, the stock's valuation has become overstretched across a wide matrix of multiples. Earnings per share forecast for 2026 and the company's long-term target of 20 to 30% return on tangible common equity will be tough to achieve, is KBW's argument. The company trades at 69 times expected earnings for 2025, while the median for consumer digital lenders is 12.2 times, according to KBW. So, I mean, we see the same arguments that are rehashed and regurgitated. And the fact of the matter is, I can make any argument I want to justify any price target I want. And nobody's really stopping me from doing that. It's just a matter of how accurate is that analysis going to be at the end of the day. So let's very quickly address some of the problems here with their valuation argument. And as I say these things, you'll realize that you've seen this before in my previous videos on analysts, and it's all very similar because I made a post earlier today, in fact, where I was saying many analysts who are bearish on SoFi come to that conclusion through a few common ways. And I'll just throw up the post on the screen. I said most SoFi bearish analyst notes boil down to a few key flawed assumptions. Number one, they're either ignoring segments of SoFi's business. Most commonly, this happens with the tech platform. Number two, they're ignoring SoFi's growth rates and prospects. So this usually comes in the form of analysts who are looking at SoFi as a traditional lender, totally ignoring the 80% plus growth rates in financial services. Number three, they're comparing SoFi's valuation to legacy players that are leveraging legacy metrics. So by saying that SoFi is richly valued because you're comparing it to like a JP Morgan or a Wells Fargo, yeah, of course it's going to look richly valued. That's where the growth rate comes into play. And number four, not taking management at their word. If management, who has been proven time and again to sandbag their own numbers, comes out and says they're going to do 10 cents of EPS, we on the SoFi retail analyst community, myself, Tanner, Chris, whoever, will say, well, if management is saying 10, the real number is probably closer to 13 or 14 because of that history. Whereas analysts are saying if SoFi's management is saying 10, the real number is probably closer to 5 or 6. And so that's just a fundamental mismatch in terms of the assumptions that they're baking into their models, which result in these models being so far wrong. Because even if we look at the most recent note from KBW and we take the 69 times forward price to earnings, where the median for consumer lenders is 12.2 times, first of all, with the market that we're currently in, I'm seeing many companies that are trading for like 69 times price to sales today, let alone forward price to earnings. But even off the bat, I see two main problems with this statement. Number one is that they're comparing this with other lenders, saying that it's an average of 12 times. Meanwhile, SoFi is one of the fastest growing out there. No other digital lender has a financial services segment that's putting up the growth rates that SoFi is doing, over 80% year over year growth rates. So to argue that this company is expensive compared to peers assumes, or at least must assume, an apples to apples comparison of what we're putting up against each other. And the truth is, when you're looking at the growth of these segments for SoFi specifically, it is such a diversified business with such a strong moat that it's very difficult to make a fair comparison, because you can compare parts of SoFi's business with other companies, but you cannot really compare their whole, because their whole is this one-stop shop ecosystem, and all of those segments in that one-stop shop are growing at different growth rates, and the combined value of all those makes it so that it's different from the other comparisons. So to say that, digital lender X is growing at 12 times and SoFi is growing at 69 times, first of all, you have to look at the product offerings and the growth rates that this other digital lender is offering versus what SoFi is offering to try to make it an apples to apples comparison. That's the first problem. The second problem with this argument is that by attaching a multiple on forward numbers, this has to have baked in assumptions on what you think those numbers are going to be. So, for example, by saying that SoFi is trading at 69 times forward price to earnings means you have an expectation of what the earnings number is going to come in to be. And the fact of the matter is that not only has SoFi itself revised upwards every single earnings they've had for like the past 3 years, but KBW has had an abysmally low earnings expectation to begin with. For example, in 2024, KBW expected EPS to come in at negative 3 cents for the full year, not for one single quarter, for the full year, negative 3 cents. And SoFi is likely going to come in at positive 11 to positive 14 cents EPS, depending on what the last quarter actually comes in at. And so the fact of the matter is that KBW is way off the mark in terms of what their earning expectations are. And so, if that's the case, then how can you calculate a 69 times forward price to earnings multiple if you have absolutely no idea what the earnings is going to be? You don't know what the denominator is, and you're attaching this multiple. It's kind of ridiculous. Like, if they're taking management's own numbers, which they're going to report at the end of the month, even that number is going to be wrong because management sandbags their own numbers. So, generally speaking, the earnings is going to be higher than what management expects. But they're not doing that. They're taking their numbers of saying, like, hey, SoFi, we were expecting them to do between negative 3 cents and 0 cents EPS for the full year 2024. That was so wrong. That was incredibly wrong. And yet, on the basis of these numbers, they're coming out with these bogus valuations. And the fact of the matter is, and I think the reason why this irritates me a little bit, is I can make any stock price fit. I can make any stock prediction fit, literally anything. And I can base it off of some EPS estimates that are so far off the mark, so far detached from reality, just to fit my narrative. And it's so easy for me to do that. I can say, as a Wall Street analyst, I can make an argument, release an analyst note to say, SoFi's profitability was a flash in the pan. In 2025, they're going to lose between 5 cents and 7 cents EPS. The growth is going to decline, and the stock price target that I'm assigning for SoFi is $4 per share. And if in fact SoFi does lose 7 cents EPS and the growth does decline, yeah, something has gone terribly wrong. The growth has cratered. The story for this company has changed. And maybe a $4 price target might sound very reasonable. But the fact of the matter is that that's probably not going to happen. If you look at the numbers, if you look at the trends, if you look at what management is saying, if you look at the growth prospects, they're probably going to come in at a much higher number, and the growth is going to continue where it is. And so my prediction, while it makes sense in isolation, in theory, has some baked in assumptions that realistically speaking are never going to come to fruition because of how outlandish they are. And so, similar story with KBW here. It's not so much the $8 price target that bothers me, nor is it the rationale that they use to justify this $8 price target, but rather the likelihood of that rationale to come to fruition, because they're not only wrong, they're wrong by a massively huge amount, and they're consistently wrong by this massively huge amount. And so that begs the question, who even listens to these guys anymore, right? I'm pretty sure that, there's other stocks that they cover that they might have higher credibility, they might have a higher success rate for, they might actually be really on the button for a lot of traditional lenders. But their track record for SoFi alone puts their credibility to question, especially because they still have an impact on the stock. Last year when they pulled a stunt, the stock fell 14%. And the logic that they used to come to this conclusion was just as flawed as a logic they used a couple of days ago on January 1st. And yet, despite all of this, the stock fell this time 10%. And I made a post to this news on X and I said, quote, the fact that this boutique firm like KBW can pull the exact same stunt 1 year later and SoFi has the exact same result only reinforces their actions to keep running the same manipulation, because it didn't make sense for SoFi to fall 14% in 2024 on a bogus downgrade. It doesn't make sense for SoFi to fall 10% this year on a bogus downgrade, especially because last year in 2024, in April, they upgraded the stock again. And now they're rinsing and repeating this exact same strategy with nearly the exact same impact on the stock. And we should theoretically be past this by now because of all the events that happened in 2024, which were all very bullish for SoFi, but we're not. The stock is still down. And, I take it as a buying opportunity because you get the price you deserve for these companies, especially the ones that have high growth rates. If you've done your homework, if you believe in the growth prospects, if you believe in what management is saying, then you do get the price that you deserve. So that's a lot. Okay. I'll just pause for a second and I'll get to the buying point in just a second with what I'm doing with my position. But the reason why I say all this is because this environment that we find ourselves in as SoFi shareholders is different from where we were in January 2024. The company now has 4 quarters of consistent profitability. They're growing very rapidly. The loan platform business is ramping. The macro is way more favorable. We've had some rate cuts behind us, and we have further rate cuts ahead in 2025. And the business is going to be reporting earnings in 3 weeks on January 27th before the market open, where they're going to be expected to release updated guidance numbers. And very likely those guidance numbers will show that management is guiding for an EPS for 2025, which is very different from what KBW is thinking 2025 is going to end up being. They were proven wrong in 2024. And I suspect, I'm willing to bet any amount of money you want on it, that they're going to be proven very wrong again, because they have a pessimistic lens to management's already pessimistic lens. And so you're sandbagging numbers that are already sandbagged when you know that SoFi actually double beats and raises. And so ultimately, this earnings call that we're going to have at the end of January, being the earnings that wraps up 2024, is going to be, in my opinion, the most important event to determine what the expectations are for growth moving forward in 2025, probably also in 2026, revive DPS numbers as well. And in addition to that, there's other events like TGL starting up, which is definitely going to make a dent, not only in unaided brand awareness, but also in the member growth. And then you, of course, have more rate cuts on the macro level. You have a new administration coming in January. You have all of these other events for SoFi that all contribute to this growth rate. And so those are a lot of thoughts that I have on the KBW note. I don't put any weight to it because of the baked in assumption that they're making. Realistically speaking, they've been wrong so often that it's hard for me to take their analysis seriously because they're using the same regurgitated arguments over and over again. If a KBW analyst comes along and they have new arguments and those new arguments actually make more sense than the last ones and they actually have some logical basis in reality, then yeah, I can take them seriously and we can have an actual conversation about them. But if they're going to come in and recycle these same arguments and it's just garbage essentially, then I'm not going to really take them seriously. And in theory, it should be hurting their credibility. But the fact that the stock is reacting the exact same way is the part that frustrates me because the market is not seeing what I'm seeing. Let me wrap up by sharing what I did in response to this news. I closed out my January 3rd cash secured puts on December 30th. That was just sheer luck because I didn't know that the KBW note was coming out. So those were profitable. And then the market was closed. And then on January 2nd, when the stock fell 10%, it was just way too good for me to pass up. So I wrote cash secured puts for January 10th. I wrote 15 cash secured puts at $15 strike price. Now, $15 strike price, you might be thinking, wow, that's kind of ballsy. And it is because the stock actually fell into the high $13 range. And, I decided to go with a $15 strike price. And I'm basically betting that this time SoFi is going to bounce back quickly. And yeah, I could have very easily written, 1350s for January 10th and still got a great premium because of how far the stock traded down. But I even wrote 15s because I think that we're going to have a very quick bounce back and I wanted to capture as much premium as possible. And, we did regain some of those losses on Friday, January 3rd. And I think that by the end of the week, we will be trading above $15 a share. Even if we're not trading above $15 a share, I'd be happy to own more SoFi because I also have calls that I purchased at $15. I sold half of those calls. I mean, granted, these were calls that I purchased last year throughout the summer, and also in the fall, I started buying more and more of these calls, and they were wildly profitable because I sold half of them at like 1650 ish in end of November. And I kept half of my calls position because they're expiring on January 17th. And I wanted to essentially convert half of them into shares at $15. But we're going to see where SoFi is trading by that time in the next couple of weeks. The other thing to keep in mind is that earnings is coming up in 3 weeks, and SoFi usually accelerates as we go into earnings. So that's just something to keep in the back of your mind in terms of how the stock reacts with these big major events. And you might be saying, okay, well, Tevis, that's a very optimistic view. You might be biased. I think to counter the other side is if SoFi breaks it below $14 and starts to descend further, that's probably when I'm going to go in more aggressively. I have some gains that I'm sitting on from Tesla and from others, HIMS and SoFi. I think 15 is where I'll nibble because I already have a massive position. It's like 25% of my portfolio or 30% of my portfolio, something ridiculous. But as we heat up and as we go into earnings and we don't see a rally into earnings and we actually see a fade down, maybe into $13 range, I'm going to be buying more aggressively. If we fall back down under 13, that's when I'm going to be really loading the boat. Because at the end of the day, this is a very different company, like I said before, than it was in the beginning of January. You've had so many positive underlying catalysts for the business. You've had so many different points of data that validate your bull thesis that the story is still intact, that I feel comfortable buying in the low teens, especially because my position is already built out. I don't want to be going crazy here in terms of just throwing so much more money at SoFi because I've already built a very significant position in the $7 range. I mean, if I didn't have a SoFi position and I was completely new to the stock, would I personally, not financial advice, but would I personally buy at $15? Yeah, of course. That's why I'm selling cash secured puts at $15 and not at $14 or at $13. So anyways, I hope you enjoyed this video. I hope it was somewhat educational for you, somewhat entertaining for you. You could probably see how frustrated I was talking about the KBW news where, I wrote some notes down here that I was reading off of. And then as I was going into the explanations, I was getting more and more heated. But ultimately, I think with a cooler head, it's because of analysts like Tim Switzer at KBW that we do get the buying opportunities that we have for the past couple of years, right? Like, because at the end of the day, you will get the price that you deserve if you've done your homework for a company like SoFi, right? It's a company that is dynamic. It's a company that is multifaceted, multi-segmented, and has different growth rates for all their segments and has an ecosystem that all plays well together. Anyways, now I'm rambling. I hope you enjoyed this video, and I'll be back to my regularly scheduled programming in a couple of weeks, and I'll see you then. Thank you so much for watching.